Let's discuss that with Michael Clarfeld. He's Managing Director and Portfolio Manager at ClearBridge Investments, and Ron Kruszewski is here. I would name you the coach there. I called you the coach. I'm sure it's not the first time, Ron. So, Michael, what do you see here? I mean, the inflation numbers were pretty much as expected. Any impediments to the Fed cutting rates next week? And then what do you expect for 2025 in terms of interest rates?
Yeah, I think the markets are saying today that obviously this sets the stage for the Fed to cut next week, and I think the markets are cheering that. I think longer term, though, it's clear that while inflation is nowhere near as bad as it was a couple of years ago, it is stickier than we would have liked and than we would have hoped a few months ago. So I think as we head into 2025, you could still see some more rate cuts, but the outlook for rate cuts is not as strong as it was a few months ago. Yeah. And I think we think that inflation and rates are likely to be a little higher for a little longer than we were all previously thinking.
Well, we came into, Ron, this year with lots of people predicting 6, 7 rate cuts for this year. And what have we had? 2. We may get a third here in next week, but that's a far cry from 6 or 7. Next year, what do you think? Do you think that the pace of rate cutting will slow?
Yeah, well, first of all, at Stifel, we said 2 to 3 the beginning of last year.
Well, you were right there.
And today, the market thinks that we're setting up for significant rate cuts. What do I think? I really think the Fed's going to do 2 more in this environment. I mean, inflation at 3.3%, pretty sticky. You're not going to get much below 4 in the Fed funds rate, in my opinion, unless inflation starts to come down. So watch the data. But this 80% that we're going to have 5 or 6 more cuts, I don't believe.
Michael, you are a little more, I guess I would say, cautious about the market given where valuations are, and you're recommending stocks that have pleasantly plump dividends or are growing their dividends.
That's right.
Explain the thinking.
Yeah, I think, as we sit here and look at the economy, obviously the economy is in pretty good shape, and that's terrific, right? We've kind of stuck the soft landing, and I think the outlook for 2025 at the macro level is pretty good.
Did we really ever land, or do we just buzz the tower?
I guess that's probably right. That's probably right. Yeah. So, the stock market's up cumulatively over 60% over the last 2 years. Valuations are near all-time highs, and as we've just been talking about, inflation and interest rates are likely to probably be a little stickier for a little longer than people would have hoped. So while we expect robust economic activity or healthy economic activity, I think after a year of nearly 30% gains in the stock market, we're a little more restrained in our outlook for capital gains in 2025.
Ron, a lot of people think we can do the three-peat, 20% plus, third straight year. We did in the 90s. Did end in the dot-com crash.
It did.
But maybe we can do it again without the crash part.
Look, I think if you look at S&P operating earnings, we think about $250. S&P's at 6,000. That's 24 times. And, to now say the market's going to be up another 20%. I mean, sometimes you got to get out your calculator and just look at it. So I'll take the under on 3 years in a row of 20%.
Because in other words, you don't think we're going to expand valuation. So we'd have to see earnings growth of that magnitude roughly in order to kind of deliver that kind of return.
It seems in this rate environment, 24 times earnings is a healthy valuation.
It's in any rate environment. I think 24 times. I think it's basically at almost the all-time highs we've seen in valuation with the exception of a couple of bubbly peaks.
Like 2000.
Right, exactly.